I'm Johnny Wu. I have my own consulting firm called Quartzy Capital Advisors. I was lucky enough to be an early investor in Simplify, and so that's why I'm here. But besides that, I'm really excited to have an esteemed panel here today. I'm just amazed, right? Just having come to the Simplify conference the last couple of years and watching the firm grow in the last 4 years, just the caliber of the people that are not only speaking on the stage here, but the attendees as well. So I applaud Simplify for all the great things that they're doing to democratize institutional strategies in the ETF wrapper and beyond. Lots of brains going on here on the stage here, and I'll give you a trivia question. One of these guys made $1 billion in March 2020. So this is a panel that you want to pay attention to as well too. So I'm going to allow our panelists to introduce themselves. I'm going to start to my left here, Mike, and brag a little bit because you guys are in like big important positions as well. So I'll turn it over to you.
My name is Mike Fang, Senior Portfolio Manager of a Maryland State Pension. It's a $70 billion of the mid-sized state pension. I manage our fixed income, currency, and commodity portfolio. It's about 18 billion out of the 70. We trade. We bring a lot of assets to manage in-house. So we trade a lot of cash bond, futures and options, and currencies. Yeah. And I've been a quant research for my prior life for 10 years. In T-roll and some prop shop trading, and then moving on to more of a fundamental. We've been looking at the QIS for past couple of years, and we try to do a lot of, we've been structured ISTA in-house, and then we do some test trade now, and then looking forward to have a good discussion with my esteemed panel in here.
Yeah. And Mike's understated. I think you have like 6 advanced degrees as well too, right?
That's in the old day, yeah.
And but working for Maryland State Public Retirement System, just being very, very progressive, being able to trade individual QSIPs, futures, QIS swaps, hiring external managers. You have the whole kind of kitchen sink at your disposal.
Yep. And I think this kind of benefit we have, right? Because we can either go out to hire the managers by ourselves, we can trade the cash, security by ourselves, or doing a derivative. But QIS is just another very handy tool set along with ETF. We can deploy it, and so with the pretty strong fiduciary duty we have, I think we get to choose different tools at different time.
Perfect. Yeah. Okay. Yeah. Roxton, over to you for introduction.
Yeah. Good afternoon, everybody. My name is Roxton McNeal. I am currently the head portfolio manager for QIS at Simplify. Prior to the role, I was the head of strategy and allocation at the UPS Group Trust, which is about $55 billion across 3 defined benefit plans. I was responsible for setting the strategic asset allocation, all the tactical asset allocation, all the asset liability management, the risk framework, and all the derivative overlay management, which QIS fit into that bucket. Prior to that, I had worked across hedge funds, both as a prop trader and as a commodity trading advisor, and actually did a stint actually hedging physical oil out of Western Africa as well.
Great. And when we first invited Roxton to this panel, he was actually still an employee for UPS Pension. And for those of you that don't know, UPS Pension has been for probably the past 7 or 8 years one of the more progressive ERISA pension plans in terms of the staff that they had, the complexity in the portfolio they were managing. And I happened to do a podcast with Roxton, so I know this. And he ran a $12 billion book within UPS. Using a lot of QIS as well. Yep. So, thank you for that.
Thank you.
And Yin, please.
All right. Hello, everyone. My name is Yin Luo. I'm a vice chairman of Wolfe Research, which is a independent broker-dealer, but we focus on high-quality equity research. My business is mostly sort of in 3 areas. One is your traditional sell-side research, then we do quantitative equity, global macro, ESG, a couple of other areas. The second part is really a global equity risk model business that we're competing with other risk model providers. But I guess for today's the intended purposes, we have a fairly sizable QIS business. So we basically creating this sort of a high quality, very high alpha strategies, QIS business. Then we put into various structures such as total return swap, custom baskets, but in particular, we also work very closely with Simplify. We have 2 active ETF and based on machine learning algorithms, which we can talk about a little later. My team has been working with Wolfe Research for about 8 years, and prior to that, I was running basically the global quantitative research and QIS business at Deutsche Bank for about 7 years, and we basically started the QIS business almost 15 years ago. Again, initially it was mostly risk premia strategies, but of course later on evolved into multiple other businesses. So I've been in the business for nearly 30 years and feels like a long time. I'm really kind of enjoying a great honor to speak with my panelists today.
And Yin, for a number of years, has always been like #1 II rank with his team, kind of in 1, 2, or the top position. So it's a pleasure to have Yin on this panel here. So let's begin. So when we talk about QIS risk premia, right? So I first got started in QIS probably back in 2011. I was at an investment bank. And the story I tell is we had a merger arbitrage strategy, right? And we took our inspiration from AQR, right? AQR had something called the Delta Fund, right? And they harvested risk premia. And the idea was that there was a merger arbitrage premium whenever company A tried to buy company B. You can hire a manager and they can do security selection and maybe do 5 or 6 deals and size them up and try to deliver alpha. What we saw was some years you had some managers do well and some years you had other managers do well. And the idea was if there were 100 deals in the marketplace, why not try to take a position in every single one of them and deliver that risk premia, right? And Barclays had a lot of success in doing that. In the early days, we had the equivalent of $1 billion exposure to that, and that the light bulb went off for Wall Street, right? And wow, these strategies, if you have good quants and a good process to kind of develop these strategies, it could be another revenue source. And so Wall Street started like investing in hiring quants, great traders, et cetera, to build out that business. And that was the genesis of it. Now, what I will say, that was 13 years ago, right? There was a statistic, Lumris had done a study of the 7,000 indices that are out there, 1,900 of them have since been killed, right? So there's kind of survivor biasship. So, as a Wall Street person, you want to generate commissions, right? You want to develop strategies, right? But oftentimes they don't work, right? So the criticism we hear oftentimes is you back test a lot of these strategies, but the performance out of sample versus in sample, you don't get the same expectation. So let's start off with that. Mike, maybe I'll start with you, right? What's been your experience when you're looking at QIS strategies, out of sample versus in sample, and how do you kind of determine what QIS makes the cut when you're considering it for your portfolio?
Yeah, and I think that has been coming a long time, as you say. When I started looking at QIS stuff, even in my older job, like there's more of a research, not a lot of product. Right now, we see that every bank doing every product. Like some bank even show me that, okay, this all of a QIS product we have, there's more than 200 or 300 in there, your own in here, right? So it's tough and obviously everything they show us looks very, very good, right, on papers, right? This all of a in sample, they are going to show you everything, but bank have no fiduciary duty. They just want to sell the product to you, right? So as the asset owner, we have our own fiduciary duty. So it's very important to understand first, like the transparency of that rule, but also another in sample tend to look good and won't look good in out of sample. But even if it looks good in out of sample, it tend to be diminished when you go live. So I think you need to take a lot of time to understand it, but also maybe do your own back testing to understand it. I think Roxton, He's kind of a guy who doing even more extreme, will do extra testing in the last step. But for us, because we are more of not as advanced as the UPS has been doing for a long time, but we need to make sure that not just performance, but also transaction cost is very important. A lot of times there's a cost embedded associated with it, even if performance looks good, but after cost, the return might be diminished as well. So there's a lot of the tiny detail in there you need to be look out for it. It's not an easy job. Yeah.
Roxton, maybe the same question for you. Having done it for 8 years, and now you're in a fiduciary role on the asset management side, having joined Simplified, help us with your thought process regarding.
I mean, it's multidimensional, right?
Yeah.
I think investors have gotten used to the fact that they can see these overinflated Sharpe ratios from QIS, where some of the more pure factor QIS strategies that are still giving you a 0.7, 0.8 Sharpe are actually probably the better strategies to be invested in, at least from a portfolio construction perspective. So we look at it in 3 phases. We look at strategy design, strategy monitoring, and then portfolio construction. So I think what we're talking about here is more the strategy design. And what you got to look for is, look, you're never going to see a bad back test, right? So you got to be cognizant of that from the beginning, and you have to have tools that you use to be able to assess what the expected Sharpe is going to be forward. I mean, we use Sharpe. You can use any kind of measure for risk and reward that you prefer. But you have to understand what the probabilistic Sharpe is, what the decay of the Sharpe is going to be. If you don't do that first and foremost, then you're going to have a complicated mess that you're trying to create a portfolio with, and it's going to blow up on you. You're not going to understand what the profile is. The other thing that's important is to have different metrics that you use to create that portfolio construction. So while most people rely on correlation or covariance matrix when they're looking at risk, we all know risk assets, they are, from time to time, more often than expected, you'll have correlation and volatility blow up, and you'll have liquidity completely decimate. And you got to be wary of that. So your analysis should take into consideration kind of a deep value look at exactly what you're trying to do with these strategies as well. So it's very important at a high level to make sure that you understand the strategies. In terms of the monitoring, you got to look forward on these using some kind of a bootstrapping or a block bootstrapping method. The banks are going to give you one time path, and they're going to say, look at this beautiful Sharpe. It's up to you to create 10,000 different paths on that and say, how has it performed across those paths? Get a probabilistic measure of what you expect that your baseline Sharpe is going to be on those, and then create some kind of a Bayesian kind of distribution analysis as well, which will give you a lot of insight in between in sample. What does that distribution look like in sample? What does that distribution look like out sample? And then also, obviously, the time component is important. You have to have some kind of measure of the number of observations that you're pulling from the distributions. How far or how far are you getting away from the Sharpe that was showing you from the banks? Another very important consideration. So I know it's kind of long-winded, but you need at least 4 or 5 different kits within your tool belt to be able to assess the strategies before you even consider putting them into portfolio and offering them as a fiduciary. That is the very first step, and that requires a lot of work on its own. And then the second and the third step require even additional work as well.
Thank you. And Yin, same question for you. One of the things I've noticed, having seen some of the QIS strategies that Wolfe Research offers, is that you folks will often show the auditor sample results and then the live in-sample results. And generally the rule of thumb from some of the investors I know, they say, hey, if I divide by 2 and they can get to that type of Sharpe performance, it's actually pretty good. Oftentimes I have to divide by 4, but I see your guys' strategies generally are more kind of the divide by 2 or better. So you're doing something right on your side. I don't know if you can share the secrets, but talk a bit about how do you think about out of sample versus in sample as you're going through the process in developing strategies. Right?
Absolutely. So first of all, I want to echo what Roxton said. Is I have never seen a backtesting that doesn't work. Right, so always works. The live performance, of course, is going to be very different. So we typically divide performance into what we call in sample, out of sample, cross-validated, and live performance, they generally speaking are quite different from each other for multiple reasons, right? So the first and foremost is about data. Is the data point in time or not, right? So my colleague Sean and I wrote a paper at Deutsche called 7 Scenes of Quantitative Investing. It's still probably one of the most white papers on the street. And basically talk about the problem of if the data is point in time or not. Give me a simple example, right? So we work with one data vendor. They claim they track real-time crude oil shipping globally, right? So, and then we took the data. The vendor claimed this is being widely used on Wall Street. It's purely point in time. We did the first testing. Again, just very simple. The correlation of today's oil shipping data versus next month's of WTI was about 60%. Highly predictive, right? So the t-stats would be like 11, 12. And then we say, well, send us the actual email distributed to clients, and we put that together. That's a real point in time. Then we did the same back testing. That correlation dropped to around 0, right? So it tells you the difference of whether the data is point in time or not is enormous, right? So this is, again, a simple data errors. The second one is just basically what you sample out of sample, we all understand, but nobody really talk about the model kind of overfitting the model, right? So we all know overfitting data, but overfitting the model, right? So that kind of almost hundreds of thousands of different algorithms, from simple linear regressions to machine learning algorithms. If you try enough of them, something always works. This is actual backtesting, really out of sample, but of course, if you try enough and still something is going to work, and this is, again, not guaranteed going to work in live environment. But this is, again, these are the problems you can overcome, for example, with cross-validation, right? So you do enough of the resamplings, and again, nothing is foolproof, but this will significantly improve the ratio of your live performance versus your backtesting performance. Right, so the third one, of course, is even if you do everything completely honestly, and there is also, again, the backtesting performance can still be vastly different from live performance, and that can be, of course, market efficiencies and arbitrage. Right, so if you look at the same value momentum performance in the 70s, that was more like a Sharpe ratio of 5, right? So again, of course, at the time, there was no factor investing. If you look at the same factors back in early 2000, that come down to 2 or 3, still very good. And nowadays, of course, is if you'd be lucky to have a Sharpe ratio of 0.5, and probably going to be materially lower if you don't have enough, or if you don't have a sufficient of risk control. That's simply due to market efficiency. Now, it was none. Now we have almost like $500 billion of QIS. Business still, a big chunk of it is on conventional risk premium strategy. And then you also, of course, have some cases that may be intentional or unintentional of the overstating the performance, right? So if you look at academic asset pricing research, right? So almost everybody does Feynman fringe, 3, 4, 5 factor, whatever you call it. And we actually had a speaker from University of Toronto did a presentation at our conference last week. So what he did was, if you download the same Feynman fringe data from Ken Grathan's website today versus exactly the same website archived 15 years ago, and then guess what? The value performance data was completely different. And of course, today's data is going to be materially better than the data posted 15 years ago, right? So again, that can be the changes in methodology, changes in data, but whatever reason, you're also going to see is even honestly backtesting can still be vastly different. So there are kind of a couple of different reasons. But again, I agree with my panelists. I think it's just, if you do it honestly, if you understand the arbitrage and understand factors and strategies also performance also depends on the underlying economic, political environment, then you will have a better chance of success in investing in QIS strategies.
So for my personal portfolio, I'm just long S&P because I think it's just really, really hard. Obviously, there's a lot of managers that can, start with the universe of S&P 500 names, security selection, portfolio construction, sizing, timing, that can, beat the S&P, and you should pay them a lot of money if they can do that, right? Because there's skill in that. Mike Taylor and beating the State Street ETF, like the 7% outperformance in the 3 years. That's amazing, right? So there are folks that have skill are amazing. Roxton, a question for you. When you think about QIS, if I think about like the returns for the big multi-strat pod shops like Millennium, right? 10% return, 5% volatility, right? That's after they took 5% for themselves, right? So for me, I'm okay with them getting all the fees if they can deliver me, the Sharpe ratio, and I can actually get those returns. When you think about QIS and being able to build robust portfolios and how do you use it, right? How do you think about that, right? Because you have an amazing track record in terms of using QIS and delivering alpha.
Yeah, I mean, we try to target between a 1.5 and 2 Sharpe on the portfolios. And for us, the secret sauce is one is in strategy design that we talked about, making sure that we understand the Sharpes, have good control over the strategies. A lot of these are wrapped in swaps. We combine a lot of strategies and create our own QIS strategies that we get from the banks. Very rarely will we use them directly from the bank. So, for example, we see an RV roll down VIX trade and in a short vol trade. Well, I know that's going to be a VIX put, a VIX call, VIX futures. They're going to be delta hedged some mechanism. I'm going to combine them into one, and I'm going to create that portfolio, and I'm going to reduce the cost. I think there's a lot of cost built into these QIS strategies, and if you don't understand that, I mean, you could have an expectation of a 7% return. During normal times, they'll say the average fee is around 3%. But when the structure actually gets active and it trades a lot, where the embedded fees pick up, they could be as high as 6 or 7%, and you're left with nothing. If you don't understand how to model the portfolio from the ground up and understand what the risk profile is and negotiate those fees, you're automatically behind the 8 ball. So a big part of what we do is be able to model that, so we can say, no, we're not going to. We know if we execute this, we can do it at a third of the cost that you're saying, and we negotiate with them. That's a big part of it as well. And then there's the portfolio construction, which becomes the third most important part, which is to be able to understand exactly what the profiles are across the different QIS strategies. There's 7,000 strategies out there. You got to be able to filter it. The first filter is the strategy design. The second one is, how do we create orthogonality within those strategies? That's very important. There's a number of quantitative methods you can use. The one that we use is, cluster analysis, some kind of hierarchical clustering or HRP, but we're doing it a different way because we know covariance is going to go to 1 or -1 some periods of time. Vol's going to pick up. That covariance matrix is going to be very unstable. So it's important for us to understand the underlying characteristics of what we're trying to capture in the QIS. So we look at things like convexity. What do we look? We want a convexity mandate. We want a benefit mandate. There's cost. How do we minimize cost? What's the reliability? You may be able to get a cheap hedge, but it's going to be unreliable, and that anti-correlation that you're renting in your portfolio is not going to work. And then there's decay. You got to be able to monetize this, otherwise, what's the point of putting it on? That's a big part of what our program is trying to do. So using those as your distance measure and a structuring of orthogonality across the portfolio actually creates risk vectors that are truly orthogonal. And then test it. You have an orthogonality during normal periods. Shock it. What's the orthogonality do? Does it come closer to the other? Does it act like a normal covariance matrix? Or does it go further apart and continue to add diversification? These are very important considerations because at the end of the day, what we're trying to do is earn excess return above beta in an orthogonal way. That's the value proposition that QIS can add if it's done the right way, and that's how we propose to structure our portfolio.
Yeah. So when I was in the street, whenever I would talk to a hedge fund, they always wanted to buy lottery tickets, right? Hey, Johnny, can I buy a call option on that? Can you strike it so I pay 2 basis points? I'm like, my trader's going to kill me. What do you mean? Like 2 basis points, like 5% out on money, and then they can get 100 to 1 payoff. I'm like, I can't do that. Then you try to solve for that strike where they were willing to pay some premium. I say, you sound like that. Convexity, orthogonal, and whatever. So that's good that you're managing a portfolio because you're trying to buy some insurance. But it's important in terms of treating the banks as partners as well too, right?
Very.
Because the one thing I would say is what's amazing across all the banks is the amount of resources that they've put in, right? In terms of hiring great talent, investing in technology, and working with you. So I have a follow-up question for you, Roxton, because my experience, having been on the other side, working with you, is that you actually collaborate, and that's a partnership piece that you have with the banks. Talk a bit about that and why that's important for you.
Like you said, I mean, these banks are hiring, extreme talent. that they have on these desks now. The last 10 years that I've been with this, you had QIS was an offshoot of the structuring desk between flow and structuring, and they'd offer some strategies. Now there's full-blown QIS groups with sales staff, and they're all super, super intelligent. And I think working with them, collaborating with them, and working together almost working with them as partners, helps both sides out. And we're not really looking to cut the fees down to say where they're not making money. My whole premise is let's just do it so it's fair. Obviously you're doing this, you need to get paid for what you're doing, but make it fair for me as well as a fiduciary, so we can balance that out. And working together with these banks and really becoming friendly with them and working with them on projects, like I said, creating these swaps. A lot of them are done with the same bank. I want to take these two strategies, let's combine them together, help me work through, what is the delta hedging mechanism on this? I want to do it intraday. Should it be every half an hour? Should we have thresholds on it? Should it be systematic? And using their expertise and the traders that they have and the flow data that they have, the research teams that they have, all of that is super important. Information is so valuable. And to keep the partnerships with the banks is one of our core principles. We'll actually go out of our way if there's two strategies that are equal to each other. If we don't have a position on with one bank, we're going to give it to that bank because we want to be able to keep that information flow.
So Mike, from your vantage point, because you can trade the individual QSIBs futures, you can do QIS swaps, you can hire external managers, you get exposed to some of the brightest external managers that are out there, right? So as you compare what an external manager can do for you versus you doing it yourself and leveraging your team, et cetera, how do you think about kind of toggling between those to try to get to the optimal portfolio?
And I think the advance of a QIS actually raised the bar for a lot of external managers. As you mentioned, right, like a lot of hedge fund or external manager in the old time, maybe just doing simple, a lot of just like put call, put strategy out there, to collect a premium. And in the old day, not a lot of people have access to this type of stuff. They can do it for us. But right now, it's so easy available for everybody, right? So pension can hire a lot of people to do that right now, right? Even your PA account, you can do all of this strategy easily. So all of this kind of easy access strategy, you can just easily do it your in-house or just like use a QIS. So that means that the external manager, they have to do a more creative or innovative strategy to create the alpha. So the bar is much higher right now. This is number one thing I want to say. So I think it's beneficial to everybody as well. Secondly, I think what we have is that because we can do all of this, so everybody is part of our strategic partners in a way. We view bank as a very important partners, but also external manager can be very important partner as well. So if I don't, and it actually helped me to balance and check with that, hey, I mean, not I don't trust anybody, but I still need to do a best of my fiduciary duty. So I can check with, like, say, the external managers if that the bank tell me that this is all the strategy they are doing in there, and I can maybe advise, get a consult from them and say, hey, how's the cost going to be associated with that? And so I think this kind of balance and check in different of the area is really kind of like, in my mind, is the best of all in there. Yeah.
So QIS can serve as a benchmark for you as
Yes.
well too, versus some of the external managers if they're delivering alpha beyond
Yes.
some of the common premiums that are out there. Okay,
Yeah.
that's fair.
And another interesting thing is that a lot of alpha used to be pretty high, and as Ian and Roxton mentioned, it become, like over time, it can decay, right? And then more and more people have access to it. And so they become either a risk premium or go away. So I think with the QIS constantly come up with a different strategy. Also, the newer and newer products out there, for example, option. Like right now, the intraday option, right? The one-day expiry option, it's very easy. You are not able to do it, a few years ago. So with that coming up, newer product coming up, you get a newer way to thinking about a different way to hedging or generate alpha in there. It's fascinating, like, always have something new. Yeah.
So Yin, at Wolfe Research, you guys don't sell investment banking services, M&A. You don't trade as well too. It's research. So you kind of have to be good to get paid, right? And your client base is all the sophisticated, long-only asset managers, absolute return managers, hedge funds, pensions, et cetera. So there's a lot that you're doing right? Because like they only pay for value. How do you differentiate yourself in terms of, having these guys be paying customers? What is it that you guys, because your teams are not as big as Goldman Sachs, right, et cetera, but you punch way above your weight. Talk a little bit about that. Like what's the secret behind kind of some of the things that you guys are doing?
Yeah, no, I guess is most of my team came over from Deutsche. Actually, most of my team been working together for more than 20 years. That kind of tells you the first differentiating factors is we have a very unique talent pool. Actually, in terms of the size of just on the quantitative research side, we probably have the biggest quant research team on the street, a team of nearly 30. When I was Deutsche, for example, global team had only about 20. So we actually have a sizable team. This is kind of unique, I guess, the features about being a boutique rather than a big bank. Right, so for example, there is a very clear of who is generating revenue and actually making money for the firm. We invest and we compete on high quality research rather than execution, as you mentioned, issues. We don't have the balance sheet. We don't compete on balance sheet. We don't compete on executions. Actually, we work with our partner banks. I have, for example, a representative from Nomura, which is one of our partners, but we also work with many other banks. So we really competing on, in terms of competing on, is really on the high quality research, and we put our reputation on the risk. We don't have a fiduciary duty, but clients invest in our QIS strategies or our ETFs, and we put our reputation. So we have to be honest, and we actually wanted to be even more conservative when we do the backtesting. So hopefully the live performance is kind of in line and maybe even better than the backtesting. That's kind of one thing. And number two is we also make enormous investments in technology, but also being on the early side of things. And again, you'd be surprised to see actually my technology budget today is actually almost 10 times larger when we were at Deutsche Bank, a kind of a much larger institutions. For the same reason as this bank, again, most banks, you have a fairly large technology team, heavy investments, but it's not very clear cut who are actually taking the bill and who are actually paying for what, versus we have a very clean business model. So we have, as long as we see the opportunity, we make very heavy investments. We want the cloud on day one. We make that investments. We invest in GPUs even way before when they getting so expensive and when AI is starting to be a big phenomenon. Actually, we invest in machine learning almost 25 years ago. One at a time, people were very suspicious. Machine learning back in the days were almost like synonymous to overfitting. People did not believe it. Of course, now it's all in the rage. The same thing goes for AI. So we make an investment much earlier on. As a result, we benefited from, we have a multi-year contracts on GPUs, and we have the capability to invest and also, of course, deliver those strategies. So that's kind of a couple of other things, but also, as I said, as I mentioned earlier, I think having a talent pool that we actually invest in very early on. We will hire students, for example, from freshmen, and we would going all the way until they're going for a PhD. But in terms of banks, I don't think many of them will have the patience to wait for that long. So again, everything from technology to invest in talents to invest in the models and trying to be as honest as possible, because we really invest in the firm rather than as a bank. And of course, you can, if it doesn't work, you can change for a different bank, but we have an embedded interest in it.
So I don't know if I should say this, but I'll say this anyways, because I think Katie and I are friends. So a couple of months ago, there was traders that left Jane Street and went to Millennium. I guess they made a lot of money trading Indian options, et cetera. So the first rule about Fight Club is you don't talk about Fight Club, right? Because then other people are like, oh, there's alpha in Indian options, let me go there, right? So you don't want to talk about it. With QIS, the conflict is that you publish everything, right? There's a rule book, right? And so, like, if I'm a hedge fund guy in a pod, but like, oh, what's that rule book? Can I take a look at that? Oh, is there an opportunity for me to provide liquidity right before they have to come in and hedge their deltas, right? Roxton, let me ask you that question, right? when you look at QIS, if things are capacity constrained, does the alpha get eroded away if too many people come in to it, right? How do you think about that, right? Yeah. Because if you have a great idea, you're collaborating with a bank, for example. Like if I were you, it'd be like, okay, Fight Club, don't talk about Fight Club. Don't give it to anyone else. Yeah. I'll take the whole thing, right? Yeah. Talk a bit about that.
So there's been certain times, when I was at UPS where we did take the whole strategy down, if it was capacity constraint. You can't do that every time. You'd have to have an infinite amount of money to be able to do that. But there were times when we do that. I mean, we're very cognizant of that. I mean, part of the analysis that we do as well is the liquidity. I think there's pockets that you can see where there is a lot of money chasing certain specific strategies. But I think as long as you're aware of that and you're able to be reactive to it when things fall apart, that's very important. You got to be cognizant of it. So it's something that we're aware of. And in terms of rule books, like I said, a lot of times we were able to negotiate the fees down substantially enough where we would even run a different ticker than was what's published. So it was our own ticker. So the street wouldn't be able to see it, and we would tweak it and change it just enough so they wouldn't really understand what our secret sauce was. For example, during COVID, I know a lot of people got beat up on the daily autocorrelation of trying to delta hedge, where the gamma completely dominated any kind of hedging that you were trying to do. We were going inside of that, and we were doing 4 different looks at delta hedging before it became popular. After the fact, now people are doing it every half an hour and on a 2-minute latency, right? But not back then. So there's certain things that we saw that we knew were happening, and we could see where the risks are. If we can structure our own product to mitigate that, we'll do that. That's not always the case, like dispersion, for example. That was getting, there's a lot of demand on that, but I think we were very comfortable because we had shifted into the gamma version. And we were really overweight the single stock volatility by about 3x of what the implied correlation risk was. So we're able to see that, and still we're still earning the implied correlation, but we had much more exposure to the single stock vol. So when things blew up, we did well as opposed to the theta version. So being aware of it and understanding it is the first step, and the second step is to being able to see it and restructure around it. And that's where the value add that we come in is creating the strategies, creating our own QIS. Once we set our baseline, start creating our own QIS that mitigate a lot of that risk.
So I've been in this business for 11, 12 years. Some of the things that Roxton says just goes way over my head. So I just wanted to say that here. So if you're feeling like, oh, what did he say? You can grab him afterwards. Ian, how do you protect your IP, right? So kind of a similar question, right? Because if you publish everything, everyone knows about it, right? It's not special anymore, right? Talk a bit about that.
That's a great question. We get that question all the time. So on the one side, of course, we on the sell side, we publish. On the other side, we're creating QIS, and also we're selling our strategies, of course, to investors, how you actually protect the IP. Right, so our secret sauce really, you always stay one step ahead of competition, actually multiple steps. Right, so we're trying to be very transparent. We publish everything. We be very specific about our strategies and models, and even give you a pseudocode if you want to replicate. But hopefully, by the time our competitors replicate our strategies, we already are on the generation 2 and 3, so a couple of years ahead of them. Actually, even the models we developed 15 years ago, you still have some of the banks still selling very similar models we developed, and we call generation 2. We are already on generation 7, right? So that's kind of one. And number 2 is of course, as Roxton and also Mike mentioned about, is you have to be very careful about the capacities. And again, you'd be surprised that some of the research ideas we published almost 15 years ago, we're taking a different spin. We're looking at higher quality data. We're looking at it from different angles. And you'd be surprised they're actually still generating fairly strong uncorrelated performance because there is a barrier of entry, right? So data is not free. Actually, data is getting more and more expensive. And also the same thing goes for computing algorithms, right? So yes, you can use GPT using API calls, but I can assure you it's not going to be ultra expensive. You're computing just even on 1 year's call transcript. That would take a long time, but also have enormous computing costs. Versus we built our own sort of equivalent of large language model, but it's smaller scale, but it's much faster and much more efficient. We can computing on, again, 10 times of larger data volumes. So the multiple ways you can go through this. And so again, as I said, it's really about competing on sort of the more cutting edge data contents and trying to analyze the data from a different angle.
Okay, thank you. And then, Mike, so question for you. So state of Maryland, $70 billion. If you think about the importance of using QIS to help with managing your overall portfolio, is it going to continue to be a larger portion of that? Is that increase, right? Because if you think about the strategies out there, the capacity for your team as well, too, because there's a lot of work, right? Or working with external managers. What's the direction of travel for you, right? Is it still early innings for you and you're looking at a lot more?
I think every organization is different. It's still early inning for us. I mean, if the way we did it compared to UPS, I would say we're way behind the way you guys used to do, right? So there's a way to catch up. But the good thing about it is that we'll become bigger, right? We'll probably be 100 billion in another couple of years. And the QIS have the scalability to put something on and then easily in there, and also have the toolkit in there is important to overlay in different portfolio. We have a huge portfolio, and we can overlay in the overall print level or in every small subset. People have their own discretionary to put on where they see the fit. So the key is that that's a very complex space. People who are doing that really need to understand it and really have a grasp of what's important, right? Because not every, the same carry strategy will be different, right? Bank from bank. The same thing might, because you do the half hour, the gamma hedging in there, or the weekly in there, but the cost can be very different too. So I think that the more complex it becomes, you need more people who have more intelligence to navigate through it. So I would imagine that we'll use more because there's a lot of convenience of it. But with the develop right now, I won't be surprised that it will blow up at some point. And people will get a bad taste of it.
Yeah, I think Bloomberg did an article a couple of months ago, and then they quantified it. It was over $500 billion in QIS in terms of institutional usage. I think the growth of this thing is kind of it's very, very exciting, right? But performance matters, right? And so good luck to all of you guys and continue to do what you do. And they'll be available for cocktails as well too if you guys want to approach for questions. So thank you, everybody. Thank you, panelists.